there's one question that no one seems to bother asking is, what is a bank reserve? And okay, so why is it the view is they're leaking in the system, but nobody knows what they are. And so I went on a kind of a mission to figure out what a bank reserve is. And a bank reserve is created when a customer deposits money in the commercial banking system. So, for example, I bank at Wells Fargo. So my money that's sitting there has been turned into a bank reserve. And how does that happen? Wells Fargo takes my money and buys treasury securities with it. That's how that interest gets paid to my account, is from the treasury securities that are backing my money. And so what Wells Fargo knows, and the commercial banking system knows, and the US Treasury knows, because we can actually go back to a quarterly report from the Treasury sometime last year, where they outlined that a typical deposit in the commercial banking system, depending on if it's a retail or a commercial deposit, is in the range of 3 to 5 years. And so all the commercial bank does is go out and take that cash, because it knows I don't need it. It still needs to pay interest. And all they do is go out and buy treasury securities. So the notion that my money that's in my account that's on deposit is leaking somewhere else, not possible.
Joining us back on Wall Street Silver today is Stephen Van Metre. He is the host of the Macro Show on YouTube. Thank you for joining us, Steve.
Oh, thanks for having me on your show again.
So, Stephen, you were calling for gold miners to crash 3 days ago. How do you still feel about that?
Yeah, I still feel that's going to happen. I mean, I look at the chart, and I've got a chart pulled up here.
Most of them already have crashed. What are you talking about?
Well, look, as someone who's bond bullish, I get it. Trust me. I used to get made fun of, and I still do, by people that are bullish on the miners. But now I think there's a tiny bit of sympathy because they're down too. And that's really interesting, because most of the time, mining bulls and bond bulls, we should be buddies. I mean, we should be locked in arms, because if you put a chart together, two of them, you see that they trade fairly similar to each other. It's only the point when they don't. And that risk off moment is when you see mining stocks, gold go down, and then you see bonds go up. And that's kind of the moment you go like, okay, there's a problem in the system. But so I look at the chart of, say, GDX, and just bounced off support, just right over 31. I don't know. I'm probably not as good as drawing lines on charts as you guys are. And I look at this massive topping pattern going back to April of 2020. And just looking at the chart, I don't know how someone could be bullish on it. Now, maybe from some other ways, through maybe there's inflation views, or from the Fed, but from a chart perspective, I mean, I look at this and say break 31, and you're going to start seeing 28 pretty soon.
Well, here's my technical view on this chart right here. If you extend that line, Jim, all the way down beneath, we're trading above it right now. So as long as we don't break through there, I'm not that concerned.
Well, you're still in a hell of a downtrend down to 20.
Yeah, but I think it's just corrective. I think it's corrective. I mean,
if you draw a horizontal line at roughly 31, that's kind of that's what I'm looking at. Is that
support there?
Yeah, if you can do that.
Yeah.
And you see that just topping pattern going back to April, and you go like, okay, well, if that breaks lower because financial conditions are tightening, that's a risk off move. And I believe me, I people like they're really hateful, and they think I don't like gold miners. I'm gonna really love them a lot. I'm just not bullish on them now, but I'm gonna be super bullish on them at some point in the future. In fact, I may be more bullish than you guys.
What do you think the Fed's going to do? I mean, you think they're tightening in some way? Explain that.
Yeah, well, the Fed is tightening. So that's what's really weird about quantitative easing, is you throw the term easing on something and suddenly it actually does what it says it does. But in fact, quantitative easing only eases if you get lending growth as a result of it. So, what is the objective of quantitative easing? Is to lower interest rates. And how do you do that? There's two functional ways you can do it. One, you reduce the supply of bonds out on the market, which is clearly what they're doing. The second component to it, and one that's harder to see unless you look at the velocity of money chart, is that they're trapping dollars in the commercial banking system. And there's a small number of banks in the commercial banking system. I think it's 12, it could be less. But if you look at where the money went from all the stimulus, it primarily showed up between two banks. So if you pull the velocity of money chart and you look and you see velocity is not moving, so dollars are getting locked up in the system. So there's two things you get out as a result of that. You get higher bond prices and higher dollar price, or a rising dollar, which is again why I am bearish on metals and miners right now. To be super bullish on them at some point in the future is because until we see lending growth, which we're not seeing at all, the year-over-year rate of change on all loans and leases at commercial banks is negative, slightly negative right now. If you look at that and you look at the lending data, it tells you that rates are still too high. And so as the Fed continues to put downward pressure on the long end of the curve, where they're doing most of their QE purchases, and they trap more dollars into the financial system, you come to the reason of why is it tightening? Because when interest rates go down, it's a sign financial conditions are tightening. It's not until then, again, you get the spur of lending growth and new money that's created that actually can counteract the Fed's purchases and drive rates up. So from my perspective, I see what the Fed's doing is tightening. And to me, what we're seeing in metals and in miners in soon to be emerging markets as it's rolling over too, is just an indication that financial conditions are indeed tight.
So did you see the recent video by John Titus where he was sort of discussing this? Because he was referencing you also at the time, where he was talking about sort of that split circuitry monetary system where there's the reserve systems, and then there's the retail system. And normally these reserves don't cross over into retail dollars.
I don't know who John Titus is.
Okay, well, he was discussing all of this and explaining how a lot of this Fed creation of reserves is leaking into the retail system. And I guess you don't agree with that sort of concept that reserves can leak into retail?
No, not at all. Because okay, so that was a big. I remember like 18 months ago when I first went on Real Vision and was talking about that. That was the big question. Is that started coming out after that was reserves are leaking in the system, and there was lots of people and lots of well-educated people I read their content and respect were saying this, and I'm like, it doesn't make a lot of sense. And then I talked to Jeff Snyder and he's like, no. And so I thought, there's one question that no one seems to bother asking is, what is a bank reserve? And okay, so why is it the view is they're leaking in the system, but nobody knows what they are. And so I went on a kind of a mission to figure out what a bank reserve is. And a bank reserve is created when a customer deposits money in the commercial banking system. So, for example, I bank at Wells Fargo. So my money that's sitting there has been turned into a bank reserve. And how does that happen? Wells Fargo takes my money and buys treasury securities with it. That's how that interest gets paid to my account, is from the treasury securities that are backing my money. And so what Wells Fargo knows, and the commercial banking system knows, and the US Treasury knows, because we can actually go back to a quarterly report from the Treasury sometime last year, where they outlined that a typical deposit in the commercial banking system, depending on if it's a retail or a commercial deposit, is in the range of 3 to 5 years. And so all the commercial bank does is go out and take that cash, because it knows I don't need it. It still needs to pay interest. And all they do is go out and buy treasury securities. So the notion that my money that's in my account that's on deposit is leaking somewhere else, not possible. It cannot happen.
Okay, but
because it's in my account.
Okay, so what's leading to all the inflation right now in the retail sector, in daily consumer goods, and in asset prices? What's creating all this inflation?
A lot of it is due to the pandemic. I mean, supply chains. I mean, when I go to the store, I still see shelves that are somewhat barren. I mean, you look at the housing market, all of a sudden people wanted bigger homes because they were working from home, or maybe they had family moving home. And so they went out and bought homes, and there wasn't supply of them, and there wasn't enough people out building new ones. And we see the same thing in the vehicle market, where there's a chip shortage. So all of a sudden prices start to go up. So there's a lot of things that are pandemic related that are being directly pointed to the Fed. It's all your fault. And it's like, well, if we look at the lending data, we could argue that, yeah, the rates are low, but they're not spurring lending growth. Now, from a market perspective, is how is the Fed driving stock prices up? Well, go look at margin debt. I mean, last month was all-time high in margin debt. So people again are saying, oh, it's all the Fed's fault, as they literally go borrow money and buy more stocks. And so to me, it's odd that the Fed does get blamed for this. And I'm sure there is a piece of this that we could say, okay, did monetary policy create some inflation? Yeah, we could probably say that. But can we separate it out from all of this pandemic noise? We can't, and that's the problem.
It sounds to me like you're in the transitory camp there, Stephen, with the inflation.
Oh yeah. Some people said I'm the king of the transitory camp. I don't know if I am, but I'm certainly pretty high up on the list of people who see that inflation is transitory. And one of the easiest ways to do that is you can take a year-over-year rate of change chart of the consumer price index, and you can chart it against a year-over-year rate of change of the crude oil of West Texas Intermediate, and you'll see energy is a fairly volatile and fairly key component in inflation. Now, it's not the only one that matters, but it's one that does show up quite a bit. And what you can see is the year-over-year rate of change in crude oil is down significantly. It's not negative; it's still positive. And you'll notice that the consumer price index lags that. In fact, the consumer price index is one of the most lagging indicators that we have. And it's minimally lags by around 6 months, and it can be longer. So we start to look at that in the crude oil and say, well, that's telling us that inflation is rolling over. We can look at the ISM manufacturing PMIs. There's a subcomponent called prices paid. We see that it's peaked, and usually the CPI lags peaks in the prices paid some component by about 3 months. And you start to think about some of these things and like, why does that make sense? Well, a factory takes in, commodities, and those prices are rising, and then they manufacture them, and then they try to sell them off to the consumers. So as commodity prices start to cool off, then you see manufacturing prices start to cool off, and then eventually a consumer who's on the very end of it, they start to see it last. So absolutely 100% on the transitory side of this, especially given the nature of what QE is doing and tightening financial conditions and trapping dollars in the system. If we do see the dollar take off, it's just further validation that the inflation story is going to be just that, just a story.
So if you were a Fed chair, how would you attack this? The way I'm seeing your view is that you think we're just in a deflationary death spiral, and the Fed is just adding to it. What would you do differently?
Yeah, so the more interesting thing to go before we answer that question is our monetary system is inherently deflationary. And so it's just, if you look at what the Fed's game is for the last 40 years, it's lower rates create credit growth, lower rates create credit growth. Well, there's a point where they're not going to be able to do that. And I think we will see kind of that end game of the Fed's monetary power at the next crash, because that's the point they're going to do more QE. And that's the point where they won't be able to do anymore. That it'll be like, look, we're doing $1 trillion a month or whatever the number is. And they're going to just, vacuum up all the treasury securities there is, and they're going to be out of ammunition. Long term, if you said, okay, what should the Fed do to really fix this problem and to really create sustainable inflation, is you have to take and swallow a very big pill. And that is, you actually have to unwind the balance sheet, raise the federal funds rate, and do it all in front of a camera and tell everyone how it's not going to crash everything, and then it's going to completely annihilate the whole economy, because it'll just destroy credit growth, destroy asset prices. And then once those come down, then you can actually get measurable inflation and keep the federal funds rate up, keep the balance sheet low, and you can create sustainable inflation. The other thing you'll need to do is you need to get the government involved in that. And the government needs to actually go from a massive deficit spending program to one where they have a surplus. And they're a huge component in this.
That's complete fantasy land. That'll never ever happen.
We just ran our Ron Paul interview, and he was like, "This, we know what should happen. It's just not politically even remotely feasible." I mean, they're gonna, you listen to guys like Kyle Bass or whatever. It says, yeah, we all know what they should do, but they should balance their budget. They should, raise taxes, have a balanced budget, raise interest rates, actually accept a reflation, and they should actually accept a recession happening, and let it run its course and let bad companies go bankrupt. They should do all those things, but they can't.
No, because the fear of what that is so much worse than actually doing it that they can't bring themselves to do it. I mean, and you kind of get it. You look at the baby boom generation, which is a generation, you look at the pension system, they're by and large underfunded. And we do know that in the midst of all the pandemic, the government did some things to help pension funds out. You look at their 401k balances or the IRA balances, they're too small for their lifestyle. And you run this massive risk of this generation that right now is the biggest spending generation. You take that away, you cut their asset pool in half, they're going to quit spending and they're never going to come back and spend.
Yeah.
So you have no choice. This is what's really interesting. People, it's easy to sit back for all of us, say what they should do. But if we were the Fed chair, if any one of us was the Fed chair, guarantee you we wouldn't do any of that. Because the whole notion, right? That you're going to sit on that throne and be the person that goes down in history as wiping out trillions of dollars or more and destroying the economy? Not going to do it.
Paul Volcker did it.
Yeah, but
he's widely respected now for having done it.
Yeah, but there's a big difference between the 70s and now. Is in the 70s we were coming off of we're really finally coming off we had come off the gold standard, but what was really starting to happen is we had this huge commercial banking system, and that's where really you get inflation. You need commercial banks and you need lending. And as Janet Yellen pointed out, as during the financial crisis, as we had bigger banks swallowing up smaller banks, it's easier to regulate smaller number of banks. Yeah, because lo and behold, it certainly is easier. So what we had back in the 70s is the monetary system expanding into the financial system because there's no regulator. I mean, if you look back, gold was a phenomenal regulator. I mean, it did exactly what it's supposed to do. Yep. And that's why it was great. But when you took us off the gold standard and over time, and all of a sudden you get the boomers starting to hit the economy, they start borrowing money. And next thing you know, money's just multiplying like crazy through the system and you get inflation. So he had no choice. But that's a lot different. I mean, they did have, a lot of money creation. Today, the issue is largely pandemic. So we have two different systems. So even if the Fed did raise rates right now, it wouldn't actually ease conditions. It would further tighten them. I mean, it's one of those weird places where, how can easing not be easing and tightening be tightening? How can Steve? That doesn't make any sense. Well, it comes down to credit growth. If the Fed raised the funds rate to 5% and Treasury yields went to 10, are people going to borrow? No, they're not. They're not borrowing now. So you have to get to the point where people are willing to borrow. And that's the issue. So back in the 70s, it was easy. You had all this massive money creation going on through the financial system. The right move was to raise rates. And then what did he do? He set off effectively the best 40 years this country may ever see from an economic standpoint.
Well, don't you think the next step is going to be helicopter money? I mean, just UBI, just create dollars, insert them directly into people's checking accounts with digital currencies or something like that? Well, I mean that's just direct inflation creation right there. Yeah, direct from the Fed, direct to your checking account.
So the question then is, will the Fed repeal the Federal Reserve Act, or will Congress repeal the Federal Reserve Act to give the Fed the ability to print money? And they don't have the ability now. I mean, we can borrow it for as long as we can get away with that. And we can send people money now without having a central bank digital currency. And that does create inflation, right? I mean, you put people at home, so they're not out producing, they're consuming, and you give them money, and lo and behold, they'll spend it. I mean, what we learned that they will spend it, but that's not the kind of inflation you really want. At least that's not what
that's the most politically. Would you agree that's the most politically likely path that we're on?
Is for Congress to repeal the Federal Reserve Act?
No, just more stimmies. I mean, people get desperate.
No. I'll tell you what, I think Congress is really learning a lesson right now. And I think what they hope what happen is, okay, hey, we're going to give you some money to get through the pandemic. And then you're going to go get your vax, which, I don't know what percentage of people haven't done it yet. But the idea of, we heard when Biden took office was, we're going to hit, 70+% or whatever its targets were. And then the economy is going to reopen and you're all going to go back to work. So what actually happened? People took all their money, spent as much as they could, drained all the shelves, drove prices higher, didn't want to get their vax, and now don't want to go back to work. Now, at some point, you could say, well, it did create inflation. Prices did go up, not the right kind. But there's another problem. At some point, people not being at work impacts a congressman's life. And they don't like that. And they could deal with it for a while. But when you start impacting their ability to live their life the way they want it, they're not going to go with it. So the idea is I think what they're seeing is we did effectively a UBI, and look what the outcome was is people don't want to go back to work. In fact, they like staying at home and they like getting these checks. And I don't think Congress really likes that too much.
Well, they seem to have trouble stopping these things once they start them. Like for one example is the eviction moratorium. I thought that was going to end in the recent weeks, and here we are. They just extended it through how much longer is it? A couple more months or something? Or the student loan thing, they deferred all payments on student loans. It was supposed to restart, but I saw that they just extended it through like January of 2022. Correct. And I gotta be honest with you, come January 2022, in an election year, I'm pretty sure they're going to extend student loan deferments for another year till January 2023 past the midterms. I mean, there's the biggest asset the U.S. government owns is student debt, which brings in $100 billion a year in interest payments, which they're currently not collecting.
Yeah, it's fair.
They can't stop. They can't stop giving extensions of these. They're not technically entitlements, but they're effectively entitlements, right?
Yeah.
You don't have to pay your rent, and you don't have to pay your student debt anymore.
Because the economy, you want to watch the economy go boom, faceplant? That's what they know it. And that's the problem is they know it didn't work. And how do you, like you said, how do you stop it? How do you unwind it? And the problem is at some point they have to, because you go back to the financial crisis. What do we teach people? Oh, you don't have to pay on your mortgage. Cool. You can default, and a couple of years later, you can buy a brand new home. Don't worry about it. So what are we teaching people now? Oh, you don't have to pay on your student loans. Don't have to pay your rent. Don't have to pay. At some point, if you teach enough people don't have to pay, and then you start making them pay, you have a revolution. They're going like, I'm not going to pay. You know what? What are you going to do? Put me in jail along with everyone else? And next thing you know, the whole banking system collapses, and there goes the empire.
Well, here's the mortgage issue, or not the eviction moratorium. All those mom and pop landlords, lots of people don't realize it's not wealthy people who are landlords. A lot of these people who own townhomes or little apartments or student dorms or whatever, this is middle income people who are not getting any income right now from their rentals. So they're not paying their mortgages, but they got equity because asset prices are so up. So they're going to get foreclosed on because they're not paying those mortgages on the rental properties. And the bank's going to get their money when they foreclose on the equity because it's inflated. And then BlackRock, who has a 0.35 cost of capital, ends up buying everything, and we all rent. I mean, it's crazy.
Until housing prices collapse and BlackRock decides they want to sell, and there's an illiquid market, and then they look real stupid. But you're right, and it's even worse because landlords, they have expenses. They have property taxes. You have insurance. I mean, they're actually losing money. And I'm impressed that people are holding on as long as they can. But yes, this whole thing, there's a point where you really need to rip the Band-Aid off, and they're afraid. They're really afraid that is still bleeding under there. And I think they peek and go like, "Oh no, we don't want to do that." but you have to at some point. Yeah. It's like I mean, because this is what really gets me, and I love this because the government really works against itself in the data. You have allegedly 10 million jobs open. Now, I don't actually believe there's 10 million jobs. I don't know if you guys believe it, but I'm relatively sure there are not actually 10 million jobs. And I've had people email me and say, yeah, my company, we run jobs. All this, we've been hiring for the same position as long as I've been here. We've never interviewed. I have other people that said, my company hires people overseas, like in India, but due to the laws, we have to advertise a job here. So we get applications for it, but because the wages are so much lower in India or other countries, we never hire the U.S. worker, but we always are advertising. So the government now, you hear Congress, some people in Congress say, well, there's 10 million jobs open, and there's, 12 million people on unemployment. We can do the math, go back to work. But the problem is, I think the government data works against itself because here you have this case of you don't need stimulus because there's all these jobs. Go get them, but I don't think they exist.
Yeah.
we on Wall Street Silver don't really believe in any official government stats, including the CPI.
Okay, so I'm safe to say that any government stat you guys are not going to
Suspect of.
take at face
Yeah.
value.
Yeah, we're suspect of for sure. I mean, we look at inflation. I mean, it's been so obvious over the past.
We look at inflation and add 5. All right, that's
pretty much. You know, and I mean, we go to the store. We know what things cost. You know, there've been shrinkflation for decades. So I mean, it is what it is.
Yeah, although of all the metrics, probably the CPI is one of the hardest things for the government to do, and probably arguably one of the ones they actually do a relatively good job on. I think the argument that people don't like it comes from what things they choose to measure.
Yeah.
But of what they do choose to measure, they actually are reasonably pretty accurate about it.
But you know, the housing number they just had, you know, the most recent one, the 5.4 or 5.9, whatever it was, they showed almost no inflation for housing, which is like 30 or 40% of the metric, which is the only reason it was kept at the 5 level, because they when in reality, I don't know how they hedonistically adjust no housing inflation. Maybe it's because no one's paying the rent, so they are able to put in a goose egg there for that number. But if they actually recorded,
There's definitely been deflation in the housing market in cities.
yeah,
So maybe
Yeah.
that kind of
Yeah, because they don't use housing prices; they use rent equivalent, and I don't know.
well, if people aren't paying the rents, what number do they put in? I mean,
right. If I'm not paying rent, is there rent equivalent to 0, or do they
it's
use
a negative
the expected
number,
rent, or the
it's
actual rent?
minus 100% in the rent figure because no one's paying.
Stephen, I have a question for you.
Sure.
You mentioned basically some sort of end day for the Fed, like the game is just going to be up. Do you see that on the horizon in the near term? Do you see anything that might precipitate such a event where they're pushing on a string, and whatever they do, they just can't win?
Yeah, whenever the next crash does occur, and I mean, we can look at the markets. We don't look at the S&P 500 and the Nasdaq to see it. Look at other places. Again, this is why I like to look at metals, miners, emerging markets, small caps, commodities in general, because you start to see it. So the end game for the Fed is they'll have to go out and do more QE. I mean, it's their only policy tool left. I mean, they do have some margin. They can, effectively buy out the entire, treasury bond market around the world, or as much of it as they can choose to. At that point, they will literally be pedal to the metal, and we will see where monetary policy doesn't work. In fact, we've heard, I think Powell kind of mentioned that, or some of the Fed speakers, that it's not really working as well as we thought. And I don't know if they said it publicly or if I remember reading it in their minutes, but they're kind of saying it's not really working like it should. And so once we hit that limit, then the next step will be direct stimulus. And then of course the path after that will be, perhaps actually money printing. I do believe that will be the last step. Whether we will get to that or something else will come in the middle of it, I don't know. But in the next downturn, we will see the end of the Fed's effectiveness from a monetary policy standpoint.
And what happens then? Is it like reset time, new currency?
No, we'll see. We'll see fiscal. Oh, you mean after all of that?
Yeah. When the Fed loses all credibility and doing a $5 trillion QE has no impact.
Fiscal.
The Fed's lost credibility at that point. What else is there at that point?
Fiscal stimulus.
From who?
They'll borrow money under the, oh, look, the Fed's buying up all the debt, so we'll issue all the debt. And they'll do that for a while. And then the question becomes is, when that doesn't work, where do you have, what happens next? Do you have a currency reset? Do you have a world war? Do you inflate do you give the Fed the ability to print so we can hyperinflate the dollar and then have a world war? I mean, what do you have? Or do you have a revolution? Maybe people just say, hey, look, we're sick of this and we don't know what it is, but we're going to topple the system. I don't know what happens next. I do think Brent Johnson's milkshake theory could be a possible play there, where foreign countries and foreign central banks say, look, we don't want to see the end of the system because we're benefiting from it. And we need the United States, so we will print money because they can't, and that they could do for a while. So there's a number of things that I think they can kick the can down the road pretty far, but there is a point where none of it works.
Well, this has been an interesting discussion for sure.
Come on, give us a date. Give me a date.
Oh man, I'm so bad about dates that I'm sure your fans are saying, yeah, don't ask him for his opinion on timing. He's the worst.
Well, give me one.
Well,
I'll delete the video off of YouTube if you're wrong. So don't worry, there won't be any evidence.
There's no evidence. Yes, I love it.
well, Steve, we want to thank you so much for joining us here. Thank you.
Oh, it's always a pleasure to hang out with you guys.